59.43 on the S&P 500 and 43. Nobody can see my screen? That's not good. And how are we doing over here? I'll just tell you what it says. So the Russell says 23.97, which is almost 24, which I'm pretty sure is getting back to their high. Oh, okay, good. Let's take a look at that. Oh, let's see where we are on the big picture. How about that? Oh, yes, I meant to sell that. Leftover oil contract. Okay, that'll either trigger or it won't. See, that was a good run we had on oil. Oh, there it goes. So we were going to look at the futures charts. And we got the Fed. Make sure you guys remind me we have the Fed at 2 o'clock. That's important. Holy crap. All right. So we've got, these are the futures and not exactly where the indexes are. 43,778, 59.40, 208.17, and 23.95. And if we go into the Wayback Machine, I'm pretty sure actually the Russell had a high that long ago. See, that was their big high. So back in 2021, people forget this, the Russell peaked out at let's call it 2350-ish, yeah, but it did touch 2400 at some point, like right there in that spike, but that doesn't mean anything. So we're back to the all-time high for the Russell, but look at the ditch it took after. Went all the way down to 17 from 24, which is, wasn't really 24. So let's say 7, well, if we say 2350, then it's down 650, right? So 650 divided by 2350, 27%. So it dropped 27% after peaking out here. So you always have to be careful when you get these highs, because they could look good. They could even look like they're sustaining. I mean, that's a whole freaking year of sustaining that level. And then it fell off like a bandit, 27%, went nowhere for the next 2 years, and then started taking off again just to get back to where it was in 2021. And that was with super low rates and every other possible benefit it could have had. What's the variable? For small businesses, the dollar is a variable. So, oh, shit, no, you want to look at the same thing. So the dollar had gotten much cheaper, which is not necessarily, I'm sorry, from 2021, the dollar started getting more expensive. Put it in that perspective, it went from way down here. This is why the Russell peaked out, because the Russell likes a strong, I'm sorry, that's not right. Small businesses like a strong dollar because they make their money in dollars. Small US businesses like a strong dollar. So this whole thing is weird because the dollar got stronger. So if you look back at the Russell, so in 2020, it started going down at the same time the dollar was going up, I think. You know, so I could put these things together. Yeah, the dollar was going up and the Russell was going down, which is not normal. That's not a usual reaction. I mean, look at how strong the dollar did get. Went from 90 to 110. That's huge. What a run. And then we had, and that's because because we recovered from COVID better than most countries. Can you believe it? Like we were kind of getting done with COVID around here, and things kind of got back to normal in 2022. Wow, was it that long ago already? That's crazy. It seems like it just happened. I'm still traumatized from the whole thing. Anyway, so that's where that was. So for other reasons, frankly, not for dollar reasons, for sure, the Russell just kind of fell apart. And yeah, there's reasons because everything was still, here's all the stimulus from COVID that offset the problems. But when they stopped doing the stimulus, oh, that's what it was, yeah. Because when they stopped doing the super stimulus, like they were just handing out money to small businesses and stuff. When they stopped doing that, there were problems, like downtown districts where there were no people, and it was tough for a lot of small companies. Think about what that affects. All this empty office space in New York and stuff. All these half-occupied buildings. That means the cleaning services, all the restaurants in the area, and the other kind of shops in the area that people frequent. There's no foot traffic for all the retailers around those areas. Doctors, dentists, lawyers, things like that. That they all. It's like an ecosystem from all these companies, the large companies that feed off the small companies feed off of. And it's a problem. Now, of course, when you're saying a small cap, a Russell small cap company is generally, these days, I couldn't even tell you, it's in the low billions, and it's, let's say it's like 100 million to low billion kind of company. It wouldn't be, the Russell 2000 is not necessarily small. It's not mom and pop shops, but it is, just a lot of neighborhood places, a lot of small companies you don't really know about make up the Russell, and they are the kind of people like Merry Maids or something like that, or somebody's cleaning services, painting companies, things like that. They're going to be in the Russell. That's the kind of companies you're looking at down there. I mean, they're still big compared to any single operator that you have, but people who have little chains of things and so on and so forth, those will end up in the Russell. And the S&P, I mean, as you can see, the S&P the Russell was outperforming the S&P for a while. It went from 1,000, right? So the S&P was at 2,500. So the Russell was at 1,000. It went to 2,000 in 2021. The S&P went from 2,500. It didn't go to 5,000. That would be a double, right? It didn't go to 5,000 until a year later, till 2022. But the Russell had spent this whole year sort of waiting for the S&P to catch up, but then they both fell. And then the S&P resumed taking off because the large caps got their post-COVID shit together faster than the small caps. Because they just have the maneuverability, they have the cash, they have the lines of credit, etc. Now, this is kind of what's wrong with this plan to deregulate businesses and allow all this M&A to start up again. I don't know if you guys remember, but I mean, I was an M&A consultant back in the day, and there were leveraged buyouts and things like that that wrecked this country back in the 80s. And the idea of a leveraged buyout is you would take advantage of a situation like that. So these companies here would be able to take advantage of all these companies here when they're struggling and pick them up cheaply, consolidate, and then there's no other competition. They just go up and up and up, and all these little businesses get destroyed. That's the problem with too much deregulation, and that's a big, big change we're going to be seeing from the election. Is you're going to see a lot of deregulation. It's going to allow consolidation, and it sounds from a business perspective like a good thing, but what happened is when we consolidated everything back in the 80s, you had all these megacorps, and then if one of them goes bankrupt, you got a huge problem. When there's only 3 airlines and one goes bankrupt, you got a total chaos in the transportation sector, and that cascades out. If you have, we only have, we have UPS and FedEx, right? So if something happened to UPS or FedEx, the other one couldn't pick up the slack from the one that died. That's what happens when you have duopolies and things like that, because you can't. You don't have a real competition. You have 2 things like Boeing and Airbus, right? That's another one. If Boeing went bankrupt, which they weren't too far off recently, if Boeing went bankrupt and ceased operations, then there wouldn't be enough airplanes for a decade. It would take a good 10 years before Airbus or some other companies could fill in the gap of losing Boeing. and you'd have planes aging out, you'd have you'd have to, there'd be lower and lower airline capacity for like 10 years, and air travel would become unbelievably expensive. Cargo transportation, air cargo freight would become very, very expensive because they're using those planes. It would be total chaos. It would cost you double, triple to go somewhere because there wouldn't be enough seats to take you anywhere. You leave yourself very vulnerable when you rely too much on a few big companies. And yet we tend to anyway, but that's why we have regulators who look at these roll-ups and they say, hey, no, that's no good. It's too risky. Not too, you, the company, might not feel it's risky, but the government looks at it and says this is too risky because you're risking the availability of your services to the American people. And yeah, it can be healthier to, and you say, oh, well, what about like Spirit Airlines? They're struggling and they're going to go bankrupt anyway. Yeah, but if they naturally go bankrupt, then their capacity would be absorbed in a capitalistic, fair manner by whoever wanted to buy more planes and add more routes and so on and so forth. It can be absorbed because there are a lot of competitors who would absorb Spirit's traffic, and they're not that big anyway. But they're, so it's different than if American Airlines went bankrupt. But if Spirit goes bankrupt, they've got X amount of routes. Maybe they've got 5% of the market or 3% of the market. So that 3% gets absorbed by the other 97% over a not too long period of time. And the consumers are relatively unaffected. Whereas if a 20% of the market carrier like United Airlines or like Delta Airlines picked up Spirit, then they become, instead of a 20% carrier, they become a 23, 25% carrier. And now they are more too big to fail. They join the too big to fail category. And that's what the regulators look at. They say, oh, no. You're passing a limit we're not comfortable with. We're not comfortable with you being 25% of all air travel. We're not necessarily comfortable with 20%, but you can do about it. Companies growing organically, but when they start acquiring people, the government can put their foot down. That's what the government's for. That's the whole point of having a government, is to have somebody be the adult in the room and say, no, you play fair. They're supposed to say that to capitalists. All right, so I'm not going to get into a political rant about it, and it's terrible these days because everything sounds like it's a political rant. It's just an economic observation. The whole point of a government is to rein in capitalism or to make sure that things are being done for the general benefit of society, not always just for the very tiny percentage. That's why you have governments. That's why you elect them. That's why the people get together and vote. So the people have gone together, they voted to deregulate everything. It's going to be a catastrophe. It's almost certainly going to be a catastrophe. It has always historically been a catastrophe. Maybe this time will be different, but probably not. But it's great. It's a long time before the deregulation and the catastrophic after effects take place. So, you can have a good 10-year run before it all falls apart, and then everybody looks back and says, why did we ever let that happen? So we have that going for us. So right now we're in the up phase, and the markets are thrilled. The Dow is up 3.3% in a single day, S&P 2.2%, NASDAQ 2.2%. And remember the 5% rule, right? So you have 5% on the Russell, 2.5% on the NASDAQ and the S&P. And the Dow sort of in between it. But generally, it's very, very rare for a large index to move more than 2.5% a day. It's very unusual. 5% is completely unheard of. And especially to the upside. You can have a crash where something terrible happens, but you don't usually have something good. But you know what it is partially? It's because it's exactly what I was just talking about. In the Russell, there are 2,000 companies that are now technically in play. Any one of them can now be bought. There's no more there are no more rules that are stopping these guys. It says there's no rule stopping these 500 companies from buying these 2,000 companies. That's exactly what deregulation is about. It's basically saying, we don't care. You want to buy one of these guys? Go right ahead, make yourself as big as you want. Take over, you know, let's instead of having 2,500 top companies in America, let's have 5, just keep, you know, go 500 and take, and you can take the NASDAQ too. I mean, of course, these guys intersect, but these don't. The Russell 2000 and the S&P 500 are absolutely not the same companies. These are smaller companies than the S&P. The Dow is stupid. Ignore the Dow. So the S&P includes some NASDAQ companies, but only based on the size of the NASDAQ companies. I'm sorry, the NASDAQ 100, I'm thinking of the NASDAQ 2000. The NASDAQ 100, I'm pretty sure every single NASDAQ 100 company is in the S&P. In fact, we could ask that question. Start a new one. Are there any NASDAQ 100 companies that are not in the S&P 500? Two. Okay. So Comcast and Honeywell didn't make the cut on the S&P, even though Comcast is $148 billion. Wow. So that's the cutoff for the S&P. You've got to be around $138 billion to $140 billion is the cutoff for the S&P 500. So that's crazy. But meanwhile, so yeah, essentially all the NASDAQ companies are in the S&P 500, but none of the Russell 2000s are. So if you look at two indexes, this one and this one are the ones that you should be looking at. And then the NYSE and the NASDAQ are two different indexes. So things are either listed on the NYSE or they're listed on the NASDAQ. Those are the two major exchanges. So there's an exchange that carries a certain amount of stocks, and then there are indexes. The indexes have nothing to do with the exchange they're traded on. So anything in the S&P could be traded on the NASDAQ or on the NYSE. That's why it's confusing, because the NASDAQ 100 are the top 100 companies on the NASDAQ. And they tend to be tech companies. If you're a tech company, going back to the 80s, if you're a tech company, you tend to list on the NASDAQ. That was the NASDAQ's niche back in the 80s when they were just getting going. So they went after all the techs. They wanted to be the tech index, and so they aggressively they did not want the flower shop down the street, but they wanted, you know, all the tech companies they could possibly get. That was how they differentiated themselves from the S&P, which was more, you know, which was well, obviously before the NASDAQ, the S&P was everybody. Not the S&P, sorry, the NYSE. The NYSE was everybody, and the NASDAQ said, well, we're the modern companies, we're the new technology, and so on and so forth. So that's how it differentiated. But the S&P is simply the 500 biggest companies in America. So any company bigger than $140 billion is in the S&P 500. That's why poor Intel is getting the boot, because Intel's getting kicked out of the S&P 500. And why is that? Because their market cap is 105 billion. They've fallen well below 140 billion, and they don't think there's much chance of them getting it back in the near future. And obviously not, because they would have to jump up about 35, at least 35 to 40% in the next year or two, and that's not, unfortunately, that likely for them. Well, it's not a terrible amount. I mean, all you're doing is saying they're going to go to like $30, right? 2450 times 1.35, 33, yeah, so 33. So for them to get back into the S&P, and they would go right back into the S&P if they do this, but if they go back to the S&P, they have to get to 33, 34 bucks, and then they'll be back for inclusion against the next one that drops off. And by the way, keep in mind that that's a really messed up thing, because when you're looking at the S&P 500 over long periods of time, okay, so over years and years, right? So this goes back to 1996. Keep in mind that this index is not the same S&P 500 as it was in 1999. And the Dow does this too, and the NASDAQ does this too, because it's the top. These are the measures of the top companies. So what you're looking at, when you look at stock company performance, when you look at index performance, and they say, oh, you should you should match the S&P 500 or the NASDAQ. So the S&P gains 8% a year, but it doesn't really, because what the S&P does is it takes a company like Intel that's underperforming and drops it off the index, and then puts in a company that's rising. It rose, the mechanics of it are, Intel falls below the threshold of 140 billion, they are removed from the index, and then a company like, I don't know who got added, was it Dow or somebody like that? So a company like Dow that's been rising gets put in the index, so falling companies are replaced with rising companies. And that means that your whole view of the index is distorted. They're effectively cheating, because they're taking the 500 best performing companies and constantly kicking out the ones that aren't the best performing companies. So what it is really an index of the 500 best companies, not just 500 companies and how they've performed over time. Always remember that. Because all of this stuff, all these indexes, they give you a distorted view. So do ETFs. ETFs gives you very distorted views of the market, because you have to deal with what they're made up of, the components. Who shows me components? I bet you don't. But let's take a look. Let's say XLK, for example, the technology spider. Are you going to show me who's in it? Options, filings, compare, stock default, name, top 10 holdings. There you go. So there you go. So when you're buying XLK, what are you buying? Well, you're buying Apple, NVIDIA, Microsoft, and then who cares? That's 28, 30, 40% of the, 40% of it is these three companies. So when you buy XLK, you're buying Apple, NVIDIA, Microsoft. If you don't want Apple, NVIDIA, Microsoft, what the hell are you buying this index for? A little bit of Broadcom, a little bit of Salesforce, but realistically, and as you see anyway, the top 10% is 62% of the index. But I'm not an ETF person. That's why, because mostly when you're buying ETFs, you're paying a huge fee, because they charge you for their turnovers and stuff. So they're basically ripping you off anyway, because you're being charged for all their trading, and yeah, so they're in and out of these stocks and moving the shares around and so on and so forth, and it's a expense. I don't know if they have any expense ratios here, but passive dividend equity stocks. I do not see it. Account under management, net asset value, volume, performance, ATR, volatility. No, they don't really discuss it, but there is a friction cost to owning these things. There's 72 total stocks, and so 62 don't matter. You probably don't want, if you look at these 72, you probably don't want half of them, and you're forced to carry them. It makes no sense. It's like, why would you do that? You can buy these 10 stocks. Don't be lazy. Just buy the stocks you want. NVIDIA, how are they doing now? So this will be interesting. The weird thing about the Trump idea with the tariffs, NVDA, is are they going to be able to get their components? Because they get their components from China and Taiwan and Hong Kong and places like that. So what are the tariffs going to be? How is it going to affect a company like NVIDIA? Somebody made a good point about OpenAI. Like, Elon Musk hates OpenAI now because he used to be an investor in them, and they had a big fight and they broke up. And Elon Musk went on to make his own AI. And now there may be regulations on AI that'll favor Elon Musk and be detrimental to other AI companies. So there's all kinds of stuff we got to be worried about in this space. Elon Musk is behind Mark Zuckerberg. Elon Musk is the biggest hoarder of NVIDIA chips in the world. We talked about that months ago. 1/3 of all NVIDIA chips were sold to Elon Musk and Mark Zuckerberg. They bought 1/3 of all of NVIDIA's chips over the last couple of years. And that's why there's a shortage of those chips, because these two guys bought them all up. And that's the problem. Again, this is a problem when people are too rich, or their companies, it doesn't matter. But the point is, you have two guys who are so rich that they can corner the market on something and prevent all those small companies from even getting their hands on the chips. They're just not available. Not only are they not available, but now they're $50,000 a chip. And that's just like, when the Hunts cornered the market on silver, they drive up the price of silver for everybody else because they took it off the market. It wouldn't have, the price never would have gone up that much if they hadn't tried to corner the market. Therefore, though, their cornering the market became successful. Oh, don't restart now, go away. News. Oh, sure. What is this? Is it stuck? Oh, I hope this does not interfere with our broadcast. Oh, it won't go anywhere. That's terrible. Hang on a second. Can you guys still hear me? This thing's still working? Because that's when we get into trouble sometimes if this update thing comes on. Hello, anybody? I'll wait. Couldn't be much point in talking if you can't hear me. Oh, there it goes, finally. Okay, thank you. That's my go-to guy. What's with you guys? I see David and Andrew and okay, thank you guys. I was worried because this is a problem. If you don't do the update when it says to do the update, the whole thing gets wacky. All right, good. And where are we? It's 1:30. We've got a half hour till the Fed. We should talk about earnings and how they're doing so far. It's November 6th, right? 2024. Can you please give me a comprehensive overview of earnings of stock market earnings to date for the S&P 500. Yeah, I like that. Determine what the most recent relevant source is, gather detailed information, summarize and synthesize. Then he shows you what sources he's using. And we like FactSet. But that's January 2nd. See, that's very bad. Why do you look at January 2nd FactSet? %63% with revenue surprises, year-over-year earnings growth 9.6%. You guys see where he's got to check the sources. See Q1, he's looking at too broadly. He's looking at Q1. Looking at Q1. Sorry, but this is Q3 we are looking at. See, now we got better results. Q3. That was my fault. I was not specific. I just said S&P earnings, and that's why you got to be careful about what you say to them. All right, so in the third quarter, show mixed results with strong earnings but weaker revenue. 75% beat earnings, which is something I said a couple of days ago when we checked, so that's right. The 5-year average is 77% beat, 75% beat, 60% top, only 60% top revenues. 5-year average is 69%. So slippage on revenues and earnings growth is looking like 4.2%. 4.2% is nice, but inflation is 3% for the year, and that's not good. So that's very little earnings growth. And then also consider how much more expensive the stocks are. You're paying much too much money for very, very little earnings growth. That's what's going on right now. That's why we've been careful. Communication services are hot. Consumer staples are hot. Healthcare is hot. That's useful stuff, right? IT is hot. All these are good sectors. Underperforming: materials, real estate, consumer discretionary. Utilities and materials show weakness in revenue. So utilities and materials are having a lot of trouble. Notable companies: Uber, big beat. Southwest Airlines, big beat. EQT, Pfizer, who I kept telling you guys was going to do better than everybody thinks. Smurfit. Wow, missed by 141%. That's a big miss. Caesars, as usual. Caesars hasn't been bankrupt in ages. Must be a few years at least before their last bankruptcy. So it's got to be time. And then GE split into various companies and so on and so forth. So the earnings so far are not very exciting, but don't tell that to the market. Whoop. See if we can get that back up and running. But don't tell that to the market because the market's on fire. Oh, not portfolio futures. I mean, don't tell that to the Russell, right? Look at this. Wow. That's just insane. So if we go back a year, from here, 17,000 to 20,000 is like almost 4,000 now. So that's 20+% higher on the NASDAQ. The S&P, 47 to 59 is 1250. Whoop, no, that's not a thing. Where's my calculator? $1,250 divided by, did we say 4750? 4750. 26%. So basically the indexes are up over 20% for the year, yet earnings are not going anywhere. Revenues aren't going anywhere. Just paying much more money. We're paying much higher multiples than we were at the beginning of the year. And as I said, we're getting close to paying 30 times earnings, 30 times current earnings, because forward earnings are projected to be up 14–15% next year. That's the average projections of growth, is people think they're going to make 14 to 15%. Now, even if they make 14 to 15% more earnings, that doesn't mean the multiple should go up like that. Because let's here. So, there's going to be too many numbers. Let's say you make $100, right? and you have a 20 times multiple. So your share, your company value is $2,000, right? But if you make 20%, if you make 15% more, if you make 115, right, times 20 times, then you go to 2,300. So you gain 15%. So in other words, what I'm saying is if you make 15% more money, your share price should go up 15%. Shouldn't go up 30% or 40%. That doesn't make any sense. Okay, so if you make 100 and you're trading at 20 times earnings, right, then you're a $2,000 company. If you make 115 next year at 20 times earnings, you're a $2,300 company. You go up 15% on 15% more earnings. You should not go to $2,800 because at $2,800, you're making the same 115, and now you're trading at 24 times earnings. And that's what's happening in the market. The multiple is getting higher. So your multiple is expanding 20%. That's not supposed to happen at all. Unless you have some indication that it's going to get higher and higher and higher. Now, what this is about, of course, is Trump coming in. The expectations, excuse me, to the extent that you thought Harris was going to be president, or that there would be a Democratic Congress of some sort to oppose the reinstatement of the Trump tax cuts, which expire next year, then you would have to say that corporate earnings should be reined in somewhat because they would start having to pay taxes again. As it stands now, they pay 11–12% tax. If you don't reinstate the Trump tax cut, they would pay 10% more tax. So therefore, earnings should go lower. Now, that's the question: is whether or not all these rosy super estimates that they made for next year were including the continuation of Trump tax cuts or not. What was the assumption that was being made? We won't know that until really next quarter, because next quarter they're going to have to talk about their tax expectations for next year, and now they'll have to say we are or we are not including the continuation of the tax cuts. They have to say it this year or in next quarter's projections, so nobody's really been talking about what their anticipation is for 2025. Now, the market is factoring in the Trump tax cuts will extend, and they're assuming a benefit to these companies of 10 to 15% less taxes than they would have paid if they expired. But who says the companies were counting on them not to expire? See, it's all a gigantic game. But that itself is a gigantic factor. But either way, that doesn't justify paying 30 times earnings, the current earnings for a company. That's just insane because the company's only going to earn 15% more, right? So if you're paying $3,000, so if you're paying $3,000 now, and they make 100, you're paying 30 times earnings, right? But if you're paying $3,000 now, based on the fact that you expect them to make 115, then you're paying 26 times forward earnings. That's the logic people are using. So when you hear these guys on TV talking about, oh, the S&P is at 24, 25, blah, 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 25 times earnings, it's only 25 times forward earnings, times the earnings they expect to make next year. Should anything go wrong, and next year turns out to be not plus, but maybe flat or lower for whatever reason, maybe the tariffs will have a negative effect. Not that I would ever say anything bad about Trump's policies or anything else for that matter, because please don't hurt us. Oh, look, he's up to 291 votes. Wow, he has 291 electoral votes. Harris hasn't gained a vote since like yesterday. That's awful. Wow, she got creamed. Anyway, so as excited as we all are about Trump and his tariff policies and everything else he plans to do, what if there's a slightly negative effect and earnings don't go up but they go down? Well, then now you're still paying $3,000 or $3 billion for the company, whatever. You're still paying that, and then what if earnings go to 90? What if instead of going up 15%, they go down 10% next year? Well, now you're paying 33.3 times earnings. Aren't you a schmuck? And that's times forward earnings. So there's a big freaking range. There's a range you can drive a truck through between the best case scenario, and I mean plus 15% is really the best. How are they going to do better than that? So that's the best case scenario, the best taxes and the best revenues, and the people keep buying at this incredible pace, and the interest rates are okay, and everything is perfect, gets you to 15% and a 26 times earnings. But the tiniest little downtick and you're at 33 times earnings. And you know what that is? That's 7 divided by 26. You're paying 26% too much. And that's how markets crash. That is exactly how markets crash. Everybody realizes that things are not as good as they thought they were going to be, and now you're sitting here in a market where you paid 26% too much, 27% too much for whatever you're holding, and the market then corrects because the new buyers coming in are not as stupid as you were, and that's how it changes. And that's why when we see our portfolios banging higher, not the short-term portfolio, but the $700 a month portfolio is up 95%. That's incredible gains for this tiny little portfolio. So that one I got to do a review on probably tomorrow. The long-term portfolio, oh, Jesus Christ, 450%. So $2.7 million, 2.745, right? 2.745. So 2.745, and last time we did the review wasn't that long ago. It was a few weeks. Not that one. There we are. So October 15th, and it's now the 6th. So 3 weeks. Oh, for God's sakes. Is that going to help if I do that? Oh, no. Just fill. You going to work? All right, let's try that again. Anyone remember the number? I do 2.745. And we were at 2.525. So we're up $220,000 in 3 weeks, which is almost 10% of the portfolio. Yeah, right. So now it's 445 and it's 10%. So this portfolio is up, and I'm sorry, when I say 10%, it's 10% of what we had 3 weeks ago, but it's the entire portfolio was only $500,000 when we started, so it's up like 50%. It's up 40%. It's up another 40-something% from where we started, from the original amount. Isn't that incredible? But that's how nutty the market is. I mean, this is completely unnatural. So we have to, again, like we did last week, we have to again look at this portfolio and say, what do we gotta take some of this money off the table. And I already took money off the table last month. We got to take some of these things off the table. We got to cash this crap in. You can't expect this to continue. You don't make 40-something% in 3 weeks. That's crazy. But that's this insane market, and it's irresponsible not to raise more cash. It's irresponsible not to raise more hedges. We have to take some of that $220,000 and put it into the short-term portfolio and buy more hedges to protect it. And as a rule of thumb, what we tend to do is we'll take 25 to 33% of the gains, of the unrealized gains. So in other words, we made 220, going to take about $60,000. And I don't mean physically take, because the short-term portfolio has plenty of cash, but we're going to use $60,000, about 20-something% of what we gained, and we're going to buy more hedges to lock in that gain. So what we're doing is, we're, instead of making $220,000, now we're only going to make $160,000, but we're locking the $160,000 in, so we are unlikely to lose it. And that's key. You want to lock in the gains, because if you lock in the gains and lock in the gains, and then you don't lose it, you're up here instead of down here, and then you go up and you lock in the gains, and you're up here instead of down here. And then you go ahead, and then this one, you miss that dip, and you're up here, and sooner you're way outperforming the S&P. Most importantly, though, if there's a huge dip like this, you're still up here because you locked in the gains with your hedges. So doing that in anything but the weirdest possible market scenarios is going to make you a lot of money by comparison. You avoid this, you avoid that. These are the things that set you back. And if you can keep a nice steady amount going like that, you will outperform the S&P by miles, even with all that fancy swapping. But obviously we're swapping too, but that's what I'm talking about right now. We have a bunch of stocks that perform really, really well. It is time to get some fresh horses in the race. It's time to look at stocks that haven't performed as well. And how do we do that? We go to the watch list, which I don't think is up here. That's the review. That's the review again, because we always look at the reviews. I don't know if this is going to work. PhilStockWorld.com. Watch list. Oh well. Our last watch list was December 27th. Hopefully the link. Continue as me. Yeah, sure. Okay. Well, that was useless. Nope. Oh well. Anyway, we don't have time for that now anyway, because the Fed's coming. So speaking of the Fed, who's going to do this? I think your session has expired. I think I have my own thing. So crazy. It's like you can't remember how you did your password. Did I do it on Google? Did I do it on Apple? Did I do it on this? Where's Warren? Uh-oh. Explore GPTs? No. This is not showing me the way it should. I don't know how to make it show me my guides. Explore GPTs. No, apparently that's what I'm doing now. New chat. I do want a new chat, but I want a new Warren chat. Uh-oh. Oh, there we go. Thought I lost you, boy. All right. What were we talking about, just so he doesn't get mixed up? Wow. Oh, I see. That was an overview. That's a good overview. Holy cow. All right. Anyway, new topic. Time for the FOMC announcement. November 6, 2024. Time for the FOMC announcement. Let's first review the last announcement. And minutes. All right, so now we need the Fed. What is this? Beige book. No. Here we go. Doesn't look like 2024. There we go. So now we need the minutes. Okay, care about this. Yeah, it's all garbage. Dun, dun, dun. Voting for this action, voting against Governor Bowman, consistent. It was agreed. Okay, that's enough. Might be too much. Put this over here. Back to Warren. Let me too much. Ooh. Oh, good job. It all fit. Okay. Oof. Can you give me the relevant enter the relevant data since the last FOMC meeting, which was when? July 31st? What? Is it really that long ago? No. Oh, the meeting before. So September 18th. Can you give me the relevant data since the last Fed meeting? 18th that the Fed is likely to use to determine their rate status today, which is November 6, 2024. See, then I'm going to give this to Warren, because Warren doesn't have web access, unfortunately. It's a good thing, you know, it's a good thing because he doesn't do, you know, that's why he doesn't make mistakes, because he doesn't go out and look for stuff and he doesn't make things up. He just looks at what he's got in front of him and tells you what it says. Okay, great. So copy that. So what is Warren saying? So he says, Treasury yields dropped. Oh, they're going to announce it any second. GDP growth, the economy maintains solid growth, consumer inflation, blah, 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 blah. Okay, so that's what as of that date happened. Here's the intervening data. Okay, so he's saying, given the data, here's what we might say. Well, we'll find out if he's right or wrong in about 10 seconds, right? Inflation decreased, progress to target, core inflation held steady at 2.6%. Labor market, October jobs report, lowest job additions, right? Unemployment has just inched up. The cooling labor market aligns with the Fed's objective. However, this softening could also pose a risk to consumption. GDP growth projections remain stable at 2% for 2024. Business investments and consumer spending remain resilient. Markets expect a 25-point cut. The Fed's guidance implies a total of 100 basis points by the end of the year, given the easing of the labor market. With inflation cooling, Fed has leeway to continue gradual easing. However, the consistent yet modest pace of core PCE may reinforce the need for a more cautious approach. Here's the likely areas of focus. The Fed has signaled a target rate, the gradual easing, labor watchfulness, the slowdown, the robust, maintaining stability. The likely decision to cut rates by 0.25 reflects the Fed's attempt. Overall, the Fed is entering a careful balancing act. Okay, great. Great. So now I'd like a analysis of the now released Okay. Should be out. No? Why is it not out? What time do they release these things? Oh, it's not today. It's tomorrow. Son of a bitch. Nobody told me. I can't see unless I look. Damn it. I'm sitting here going through this whole thing and it's not ready yet. Oh, I feel like such an idiot. I forgot it wasn't. It's always on Wednesday. It's why it's so confusing. All right. Well, there you go. Damn. I was all ready for it too. Well, I'll use this analysis tomorrow, so it's not going to go to waste. Sorry, my bad. The statement comes out tomorrow. not today. Okay, so he's saying, given what we see though, basically, he's saying we are going to get this cut. The big bugaboo is inflation is holding steady at 2.6%. That's not coming down the way they want it, but the labor market has collapsed to zero. I don't know if you know it, but we had serious hurricanes this season, and they caused massive disruption in Florida, North Carolina, Georgia, South Carolina, Tennessee. To some extent, I think they caused the job data to be a bit off, but other effects as well, I'm sure. So natural disasters can temporarily disrupt employment, especially sectors like construction, hospitality, and retail, tend to have high exposure in hurricane-affected regions. Workers may experience layoffs or furloughs. The employers often delay hiring as they assess damages to their operations. Claims on the storms might lead to temporary spikes in unemployment claims, especially if businesses close due to power outages, flooding, or rebuilding needs. The Fed and economists often adjust to these short-term fluctuations, but they still affect the headline numbers. Hurricanes complicate seasonal adjustments in labor data, making it hard to assess trends. This is likely why recent jobs reports show unusual softness in job growth, which partially affect temporary dislocation rather than underlying economic trend. It is very serious because that's the main thing people are relying on right now, to be counting on the Fed. Increased prices for goods and services. Disruptions to supply chains, especially for essentials like food and building materials, drive up prices. Fuel costs may rise due to increased demand for transportation and rebuilding efforts, while food prices can spike if transportation routes are impacted. A surge in demand for temporary housing following a natural disaster tends to drive up rental prices in affected areas, and that hits shelter costs. Man, see all these things you got to think about. Short-term slowdown in consumer spending during hurricane spending typically slows affected regions as people delay purchases, and different consumer spending spillover effects like construction, rebuilding efforts often stimulate construction. You know, and then you got to time it before, after, during. You have to figure out what's happening when. The Fed often sees disruptions temporary and adjusts data interpretation. However, if the storm-related disruptions push inflation up or employment softness persists longer than expected, the Fed faces a challenge. The other big thing is that since September 18th, when the Fed dropped rates 0.5%, the actual 10-year rate has jumped back from 3.6% to 4.4% now, to 4.4%. And there was very poor demand at the auctions. How will the Fed take that into account. Okay, the jump in the 10-year yield reflects special forces expectations of persistent inflation, concerns over federal deficits and debt levels, higher return premium, and yeah. Investors may be pricing in a risk premium due to concerns about future fiscal stability, inflation. The weak auction demand suggests that investors want higher compensation for duration risk, meaning they see more signals of tight financial. Higher long-term rates increase borrowing costs across the economy for mortgage lenders, tightens financial conditions independently of Fed policy. The Fed can see this as a reason to temper further rate cuts. This is my argument. Given the 10-year yield is now well above the short-term rates, additional cuts might provide limited economic support because long-term borrowing costs will still weigh on investment and spending. This may cause the Fed to focus more on stabilizing expectations rather than aggressively cutting forward. In other words, the Fed can't look foolish. They can't look like they're not having an effect, because the minute you start thinking the Fed doesn't have an effect on rates and rates can get out of control really fast, that's what happened to Greece. Doesn't matter what you say the rates are. If nobody's willing to lend you the goddamn money, you're screwed. Implications for inflation and economic activity. Inflation expectations are likely being scrutinized carefully as 10-year yields indicate that investors see persistent inflationary risk. And now Trump's coming in, so it's, with tariffs and crap, I can't even imagine what people must be thinking. The Fed may interpret high yields as a reason to keep an eye on long-term inflation expectations, or they may refrain from aggressive rate cuts to avoid stoking further upward pressure on yields. So the Fed's in a really tough spot here. The Fed could address this by slowing the pace of rate cuts, perhaps opting for a 25 reduction instead of a larger cut. This move would signal the Fed is cautious. The Fed may stress its commitment to gradual easing, and the Fed may highlight its monitoring of fiscal conditions, which they always do. Given the 10-year yield's weak auction, the Fed may adopt a measured approach at the meeting, small rate cut, or even signaling a pause. If inflation remains expected, they'll likely underscore data-dependent path. Well, they always do that. Come on, nothing special about that. You can do better. All right. Anyway, so that's where we are with the Fed tomorrow. So it's no cut at all possible, or 0.25. It's weird because now you got, Trump had threatened Powell not to make a rate cut. He made no 5 rate cut. Who knows what he's going to do now? So that's got to be taken into account as well. There was a 10-year auction today, wasn't there? How did today's 10-year note auction go? Was it good or bad, and why? Oh, come on. What? It was a 10-year, wasn't there? News. Uh-oh. Oh, no, that's August. I thought it was today. Maybe I was wrong about that, too. 21 hours ago. Oh, was it yesterday? Holy crap. Oh, I would have talked about that on Monday. Today is it's Wednesday, otherwise I wouldn't be on this webinar, right? Oh, no, it's a 30-year, and yesterday was a 10-year. So the 10-year had good demand, it turns out. Okay, that's straightened out. Ah, silly me. It was a 30-year today, 10-year yesterday. Right? 30-year bond auction 1 p.m., 10-year note auction 1 p.m. Oh shit. 4.6%. That's terrible. This represents the largest daily jump in yield since March of 2020. The sell-off is attributed to Trump's election victory and concerns about future inflation. $25 billion worth of 30-year bonds. The previous high was 4.39. This is, good God, that's awful. Bid to cover 2.4, indirect, direct. November is historically negative for 30-year supply, with 75% of the auctions tailing over the past 15 years. Five of the last November 30-year auction issues have tailed. So that means that November is not necessarily a good month in the first place. So yeah, it's a good thing to check on, right? He says that's the trend in November. Non-dealer demand has been decreasing in successive auctions. See, that's bad. Similar political transition and Trump victory led to weak non-dealer demand. Treasury Department has indicated stable coupon issuance. Higher yields may attract dip buyers now that the election is uncertainty has passed. Removal of election uncertainty could attract more bidders. Whoa. So what rating would you give today's 30-year auction, and then tell me about yesterday's 10-year? What? You just had it. How did yesterday's auction perform compared to expectations? Come on. There we go. 42 billion, which is up from 39 billion. Bid to cover 249 was good. The yield was lower than the previous auction. So yesterday's auction went well for the 10 years. This was a strong auction for several reasons. So that's interesting because yet the 2-year note auction was a failure. That was like almost a complete failure. The 10-year note then the next day was strong demand, and now the 30-year note, though, again goes back to being a disaster. So these are all over the place. And of course, obviously, you know, Trump changed things a little bit. I think people are getting a little nervous about what our debt situation is going to be. And we will see what happens. So that's crazy. And this morning we were talking about, speaking of this fantastic election, what we discussed this morning was, this is a good thing to go over with some extra commentary. All right, so Dun, 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 dun. Oh, look at Tesla. They still up like that? What a win for Elon Musk, right? He throws a few $100 million into the Trump campaign, and the stock is now up 14%. Oh my God! See, it's now cost efficient for billionaires to buy elections. So if it's so from Elon Musk's lesson, what does every billionaire now know? It's like, hey, we got to buy into these elections. So this kind of behavior is being rewarded. Yeah, he's still going up. He's finishing the day at a high. What is it, 220? Yeah. So, given Trump's in office and based on his actual things he said he's going to do, tariffs of 10 to 20% on imports and 60% on Chinese. So 10 to 20% on everything. Okay, that means your avocados, 10% tariffs to 20% tariffs from Mexico. Everything. Okay, maple syrup, 10%, 20%. Every car, every non-American car you buy, or who knows what they're going to say about where the parts are from and whatever. You know, your computers, your iPhone, your iPad, your watch, your whatever, everything, your tequila. They talk about 10 to 20% on all imports. They mean all imports. It's China. He says he's going to hit with a 60% tariff. Now that's crazy, but let's look at it this way. U.S. China trade balance. Okay, so here's the thing. Our trading balance with China is $300 billion. China, we export 147 and we import 427. So therefore, if we blast China with a tariff, 60%, so 427 times 0.6 is $256 billion. That's how Trump balances his budget. He says, I'm going to charge $256 billion on anything from China. But of course, if things from China cost 60% more, we aren't going to buy as many things from China. That's simply, people are not going to do that. But if China hits us back and they say, okay, well, we're charging 60% for you, then it's 279 times 0.6 is 167 billion. See the fact, well, oh, wait, no, I'm sorry, that was a deficit. No, I'm sorry, 147 times 0.6 is 88 billion. So it's 200. So we're taxing China 250 billion. They can only tax us if they did the same amount. They would only be taxing us $88 billion. So we could, if we wanted to, I doubt it would be this logical, but we could take $80 billion of the $250 billion and subsidize our exports to China so that our exports remain the same while their imports drop off, and we could then balance the trade out with China. That would be the logical way to do it. But what's going to happen is Chinese people will simply stop buying our goods, and we won't export to China, and we'll import much less from China. China will no longer be a trade partner. We're going to force China to make trade agreements with other people, including Russia, because they need another market to sell to. So they will start making favorable trade negotiations with Vietnam, Russia, North Korea, other countries that we're not so fond of. Middle East, whatever, and they will establish better trade relationships with all those people while they sever ties with us, and we get and the net result in the end is we are no longer participating in international trade, and we have strengthened the countries we don't like. Okay, it's all stupid. You're not accomplishing what you think you're accomplishing when you do these things. You're hurting everybody. You're killing the American consumers. That $250 billion is a tax on the people who buy stuff. When you buy an avocado, when you buy the tequila, when you buy IKEA, you're paying that money. I mean, I don't know what the logic is. China's not eating that money. Nobody's eating that money. The goods are sent over here, and you're saying if you want to bring this good into the country, it's a tariff. Now, therefore, that tariff is known, so the companies selling the product in America would be well aware of the tariff and would have to factor it into their pricing when they order it. You know, if I'm Macy's and I'm buying a million dress shirts from China that were $20, that were costing me $15 each, and now there's a 60% tax on it, which is, I didn't even know the number, $9. So now they're $25 each, right? As Macy's, I have to make a decision that it's going to cost 25 bucks. It's not going to cost 16 bucks. It's going to cost 25 bucks. Therefore, instead of selling the shirt for 30 bucks like I was going to, I'm now going to sell the shirt for 40 bucks to cover the tariff. And who's going to pay that? The consumer, obviously. Macy's isn't paying it. China's not paying it. China's sending out the same freaking shirt for the same $15 they were always getting, and Macy's is paying China $15, but or it has to be landed or it's paid at the landing, but whatever. It's either paid from China's port at 15 bucks or it's paid at landing, but instead of $15 because of the tariff, there's a $9 tax on it, so now it's $24. But that's a known fact when it's ordered. It's not like you surprised them with the tariff. It's not like Trump goes, ha ha, now that you're here, I'm going to charge you. It doesn't work like that. These things are planned months in advance. He said they're put on ships, there's contracts, and all these taxes and things are known. And in fact, frankly, because we've been talking about it for so long, that all these contracts have escalation clauses in them for stuff that is there. But what's going to happen? Is Macy's going to eat that money? Of course not. Is China going to eat that money? Of course not. Who eats the money? The consumer. And who's going to hit it the most? Because in Macy's, I got a choice because I don't have to buy the $40 shirt. I wasn't going to buy it anyway. It was a cheap $30 shirt. I was probably never going to buy it. I was going to buy a $50 shirt made somewhere else. Doesn't hurt me, doesn't hurt you guys. We're the investing class. We have money. You know who it hurts? The people who are shopping at Dress Barn and don't have any money. You know, the guys in Men's Warehouse who are trying to buy an inexpensive suit. They don't have the money. They're getting whacked with a 60% charge. Now their lowest cost choices are no longer low cost. So you attack. I have a choice. I have a choice about I could go to any store and buy a shirt. I'm not terribly price sensitive when I'm going out to get something. I want a nice shirt, I'm going to buy a nice shirt. But the people who only could afford the lower cost shirts made in places like China, they're the ones that are getting killed by this stuff. And you think a 10 to 20% tax on everything is not inflationary? How can it not be inflationary? And Elon Musk even said so. He goes, yeah, it's going to be very painful the first year because this is going to count as inflation. For the people who already are worried about inflation and can't afford things and voted in Trump because he said he would do something about inflation. This is what he's doing about inflation. 10 to 20% on everything, 60% specifically on China, which will then cause China to lash back and put a tariffs on our stuff. And now the stuff that we sell to China, which is a lot of agricultural stuff also, is going to now impact the farmers here. And there will be less demand for their goods. Because the thing that the thing about China is they have a lot of mouths to feed. So they eat a lot of stuff. That's the basics in China. The rice, the grains, and things like that we send over to them. They've got 1.5 billion mouths to feed. We only have 300 million people here. If China stops eating your food, you have a very hard time replacing that market. Now, of course, China, on the other hand, they can't whack up their population. See, any country that cares about their population, they can't just say, okay, from now on, all the grains from America are now 60% more money. Not until they have a way to replace it. And with the Ukraine out of commission, there is no real good way to replace things. But again, it will force them over time to stop using American farmers, stop buying our stuff. It's disruptive, and it's a terrible, terrible thing to do. Anyway, all right, we got through one thing. Cryptocurrency deregulation. Hundreds of millions of dollars are spent in this campaign, not just on Trump, but on hundreds of congressional candidates who were funded by cryptocurrencies. Cryptocurrency community got very organized this year and put a fortune into the election to have candidates, and I think they said there was 200 of their candidates got elected. So it's 200 Congress people and senators who are funded by cryptocurrency community and owe them. So there will be a lot of deregulation of cryptocurrency, and for good or ill, however it works out. And it won't just be Bitcoin, it'll be lots and lots of coins. Now, the weirdest thing about Bitcoin is with Congress, with the House and the Senate and the courts, so you can't challenge it, Trump can simply, with a stroke of the pen, say the United States needs a cryptocurrency reserve. Okay? There are only 21 million Bitcoins in existence. They're not even all out yet, but there can only be 21 million Bitcoins. So 21 million times $75,000 each is $1.5 trillion. That's the current value of Bitcoin. So if Trump says we should have a Bitcoin reserve of $250 billion, that would be a significant amount. Let's say 300 around it. That'd be 20% of all Bitcoins would be $300 billion. It's not a big number. Not for America. You know, we have a $30 trillion economy. So to have $300 billion of Bitcoins as a reserve is not much. And if he says, I want to back up the currency, as stupid as it sounds, I want to back up the currency. Let me back up our currency with gold. So you say, oh yeah, we want to back up the currency with gold and with crypto. So we're going to add $300 billion worth of crypto to back up our currency. Now, you might say, well, you're backing it up with nothing. Gold is a physical thing that you can hold and own. And I'm not going to have an argument about whether Bitcoins are physical things or whatever, but they're, you know, Bitcoin is a notional currency. But what will happen, though, is by demanding 20% of all the Bitcoins in circulation to be taken out of circulation and put into the US Treasury, we could end up driving up the price of Bitcoin substantially, like $200,000, $300,000, which would make the acquisition of Bitcoin for the Treasury look brilliant until it all collapses one day. But it would look really smart for a while. And so I'm not against Bitcoin. We have the company Coinbase in our long-term portfolio. And it just popped $55. It's up 20% today. Even so, though, this spread, which is now 250, in fact, it hit our target. Our target was 250 for next year. So now we're at our target, and it is 776,400 minus 493,050 minus $14,925. So it's $268,000 is the net price. So if you want to buy this right now, it's $268,000. This is a, you see 150 to 250, so that's 100 times 60. It's a $600,000 spread that's in the money that you can right now buy for $268,000. So if it holds 250 into next year, which I can't see how it won't, if you've got a crypto-friendly president coming in, I don't see how it's going to go lower. This thing is going to double in 12 months. Not bad, right? You know what's even better? We bought this thing for $467,700 minus $375 minus $45,000. We bought this thing for $47,700, and it's going to pay us $600,000 back. That is how you make money. Because when we did it, when is this, from February? When we did it, nobody liked these guys. Look where it was in February. So we took a 150, 250 spread. And we didn't actually buy it because we thought it was going to go to 250. We bought it to cover the short calls we were selling. And so we sold short calls. We got into some trouble. We sold more short calls. Then finally, it calmed down. So we started making. So we've already made a ton of money selling short calls as it drifted down. And in the last portfolio review, probably here. So I said big gains this month. I don't want to sell short calls as I'm worried they will beat on earnings on 10/30. So I guess we'll wait. Well, we waited, and thank God we did, because holy crap, I would have been so pissed off if we had covered. They were at 205. Now they're at 250. And see the net there? The net there is only $200,000. So incredible winner for us, like a huge star in the long-term portfolio now. And still good for another 300,000, still good for a double. So we have a double coming to us even after these spectacular gains. It's up 400% so far, and it's going to double from here. So very pleased about that one. And what was the logic? The logic of that trade was really that we would just sell the volatility of the stock. We didn't care. We had a cover in case it went crazy, which it did. That's the point. It did go crazy because we started this trade in February, and look what the hell happened to it. But that's why we bought those covers, just in case it popped up on us. It did pop up on us, but we were able to roll and get out of trouble. We started making some great money because it started trending down. Nothing is better when you're selling short calls and the thing trending down. It hit our goal, and we thought that was very overvalued, so we heavily sold here. We made a fortune when it expired, and then we did it again. So we pocketed a huge amount of money, and now now it's back to our goal. Are we going to sell more coverage? Not right now, because like I said, if Trump gets into office and he announces a Bitcoin reserve of any kind, Bitcoin is going to go through the roof. All the other little cryptocurrencies will follow it, including Trump's coins. Trump has his own coins now, so his coins start catching on, and of course they will because they're Trump's coins, and he's going to make, he won't make his coins a reserve, or who knows, maybe he will. He doesn't seem to care about appearances, but he'll make, if he makes other coins a reserve currency, everybody's going to start speculating on Trump coins becoming some kind of reserve, and they're going to go through the roof like 10 times, 20 times, whatever, and Trump will be very wealthy. So is he going to do it? Of course he will. All right, this is the expiring tax cuts are going to be continued. We know that. Trade relationships are going to be, this is going to be trade wars all over the place. Impact on international agreements and relationships. This is another very bad thing that's going to happen is, unfortunately, he doesn't like Zelensky because Zelensky didn't give him dirt on Hunter Biden when he asked for it. Remember that? So he never liked Ukraine. Putin's his buddy. So he is going to, he may even cut off the aid that we've already promised Ukraine, but he's basically going to cut everything with them. He may do that overtly, or he may just go to Zelensky and say, hey, I'm cutting you off. And unless the EU wants to step up and provide all the aid and do all this stuff themselves, then you are about to get your ass kicked in a war. Or you can say, bless Donald Trump, he has broken an agreement, we're giving up all this land to Russia, and thank you for letting us keep this half of the Ukraine to ourselves, or a quarter of the Ukraine to ourselves, whatever. And then Trump can say, I brokered a peace. and that brokered peace will be Ukraine giving up everything, which is like what Chamberlain did back in the day. But then since that went so well, Russia's going to want more. Just like World War II. Oh, and I wrote that. Yeah, I wrote that. This is a separate thing, Ukraine war. So what happens to the sectors? Here's the tech sector. Crypto deregulation is good for a lot of these guys. Lower corporate taxes are extremely likely. Potential repatriation holidays. Repatriation means that they can take the money they've been hiding overseas and avoiding taxes on. They will be allowed to bring it back into the U.S. and that then becomes part of their official corporate tax pile. Because Google, Apple, everybody like that, they've got billions and billions and billions of dollars overseas, hundreds of billions of dollars overseas. And they keep moving it around to avoid being taxed in the, by the U.S. or by anybody, frankly. They just keep the money moving around from one thing to another, so nobody ever gets to tax it. And when you say repatriation, the logic of repatriation is you say, well, I'd rather have the money in the U.S. being used and put to work in our economy than being run around all over the world as tax avoidance. There's some truth to that, but the problem is that when you do that, you encourage more people to hide money and move it around until somebody repatriates it. Last time Trump was president, he allowed many companies to evade taxes by doing this. And for the last 4 years, they've been hiding their money and hoping to bring Trump back. And that's another reason all these companies love to back Trump, because they want somebody to come in there and allow them to bring hundreds of billions of dollars back home. Tech companies with Chinese exposure can suffer from the tariffs, as we talked about before. Social media platforms, this is another problem, because if you randomly regulate people you don't like, or have the Justice Department investigate people because you don't like them, or allow American companies like Facebook to be harassed in foreign countries, or Google to be harassed by not backing them up. All you have to do is not say anything when a company gets fined. All you have to do is not complain when you say these charges are frivolous and this country is just trying to collect money from an American company. If you don't back them up, then you can harm these companies greatly with very little effort. All it takes is a president who decides he has friends and enemies and he supports one over the other. Manufacturing, and look at how every sector is just through the roof. So there's manufacturing, infrastructure. We'll still have more infrastructure. It just won't be the right infrastructure, unfortunately. We need more solar. We need people to build homes. We need obviously anything to do with green energy is, we have to do something about the environment. That's not what we're going to get. We're going to get more road construction to put more cars on the road, more ICE cars on the road, so on and so forth, more nuclear plants and things like that, more, God forbid, coal. Buy Americans can be good for domestic manufacturers. Defense spending is likely to increase, but it won't be given to the Ukraine. Tariffs on Chinese goods can disrupt supply chains completely. That could be a disaster. Higher input costs from the tariffs, and again, it's costs are passed down. They're passed on to consumers. They're passed on first to manufacturers, and the manufacturers will pass it on to the consumers. Here's financials having a party right now. You don't regulate financials, and there'll be only 3 or 4 companies left. There'll be JP Morgan, Goldman Sachs, BlackRock, and a couple other guys. That's it. Everybody else will get sucked up into, basically be consumed, which is what we did in the 80s. So deregulation, higher interest rates based on the spending plans that Trump has. You can't fight the fact that you're spending, and you're deficit spending, because you're not taxing. If you're not going to tax people, then you're running a bigger deficit unless you cut back your spending tremendously. And what we're cutting back spending tremendously, all the cutting back spending. So you're not taxing rich people. You are taxing poor people, and especially because as a percentage of income, Social Security taxes, the payroll taxes are 12%, 13% of somebody's paycheck. 13% is the total tax that rich people pay. But for poor people, that's just their payroll taxes. Then they're paying their taxes on top of that. So you're not cutting that. Nobody's talking about cutting that at all. So poor people pay more taxes, plus they pay the tariffs and so on and so forth. So you're killing the poor people. You're cutting taxes for the rich, far less revenues for the government. So you're running a much bigger deficit. And then if you're going to cut anything, what are they going to cut? They're not cutting the military. They're cutting the social programs that help the poor people who are getting crushed by the additional taxes and tariffs. It's going to be a disaster for poor people, basically. Not only that, though, but they're talking about cutting Social Security by a third. Like, just that's how they're going to improve that program, is by basically cutting the payouts by a third, and that basically can destroy Florida. Florida could implode if you do something like that. Florida will just like collapse, because that's how all these people are paying for their apartments. Where do you think the money comes from? It all comes from Social Security down here. These guys aren't working. Higher interest rates up. Market volatility, yeah, that's fine. The big banks can adjust to that, and international relationships, they can deal with that too. Here's energy. Why did I not put that? Oh, I did. Energy up there. So obviously, big fossil fuel thing. The fossil fuel companies gave Trump $1 billion to make sure that they're taken care of. Environmental regulations will be cut, of course, and there'll be more the drill baby drill thing. And I just talked about that this morning, how the math doesn't work. We're draining. We only have 70 billion barrels of oil in America. They know this. It's like a scientific fact. Yet I have heard, Republican after Republican on TV talking about how we have more oil than Saudi Arabia. That's not true. We produce more oil than Saudi Arabia. They have 5 times, 4 times more oil than we do. They definitely have 4 times more oil than we do. So they're selling less oil, and we're selling more oil, and we're draining our reserves, and we will end up with nothing left. We will end up end up being a country, and there are many of them, will be a country with no oil because we used it all. And we used it all when it was not strategically smart to do so. There's no sense in draining all of our oil reserves just to create a short-term income stream when those reserves are critical, because God forbid we ever do get cut off in the future, we will have no way of powering our vehicles, especially because we aren't bothering to go green. So we're making ourselves completely, if you were Putin and you were planning how to destroy the United States, this would be your plan. It's like, make sure they drain their oil reserves completely. Do not let them develop alternate energy sources, and therefore in 10 years, when they run out of freaking oil and they've got nothing left, then cut them off, and then see what they do, see how they power their vehicles. It's a moronic policy, but that's what we do. Oh, didn't I say I wasn't going to complain about this? I gotta get used to being a cheerleader for these things. Yeah, that's what we're gonna do. Renewable energy might face headwinds. Yes, obviously. So yes. So pull funding, cancel Biden's programs. That he put $1 trillion into clean energy programs. Trump can remove it. He's got Congress and the courts. He can just reverse it. So healthcare, Trump, in his infinite wisdom, will cancel the Affordable Care Act, and then everybody will be forced back to private insurers. They will no longer have to cover pre-existing conditions, so there will be millions of people who are ineligible for health insurance, and they will be the people who need it the most because they already have something wrong with them. Drug pricing will obviously no longer be coordinated in such a way, like the $35 cap on insulin per month, that's gone, that'll be gone again. Private insurance is gonna make a fortune, so great, we gotta look for, this is what we gotta do, we gotta say, great, okay, good, let's invest in private insurance companies, they're going to make a fortune. How about Humana, right? HUM, how are they doing today? Ooh, 11%. So should we get Humana? Of course we should. They're private. They're going to make a fortune. They're going to go back to the bad old days. Look where they used to be. All these companies have been getting crushed because Biden and Harris have said, we're going to stop these people from overcharging. We're going to stop these people from charging $100 for an EpiPen. We're going to stop these people from charging $200 for insulin, things like that. Because it's too much. They're gouging the consumers. And why do we know that? Why do you call it gouging? Because the same company sells the same product in other countries for 1/3, 1/4 the price. How is that not gouging? They ship it from America to other countries and they charge 1/4 of the money. And they still make a profit there. They take advantage of the total crap US healthcare system. Other countries don't put up with that. Other countries say, how much do you make this for? Well, then we'll pay this. We'll give you a 30% markup. We'll give you a 40% markup. That's what we'll give you. We will not give you a 180% markup, a 400% markup. We won't do that, okay? We will not buy from you. We will buy from somebody else. Our entire healthcare system will shut your company down and will not approve you because you're gouging us. And then the company goes, oh, no, sorry, 35 bucks. Yeah, it's fine for insulin, no problem. Because it is fine. Because they make a great profit doing that. They don't not sell it. If they weren't making a profit, they wouldn't sell it in other countries. They're not selling it at a loss and making it up in America. They're making a profit in other countries and making a fortune off America. It's a sick, sick thing, and we are going right back to it. Not that we ever got away from it, but we were starting to make progress. So this crash in Humana and other private healthcare companies was caused by Biden and Harris and their policies, and now it's going right back. So obviously, great place to invest. Consumer discretionary, that's still kind of scary. They're doing, they're doing well, but this tariff thing, it's going to kill disposable income. It's going to be a scary space to be in. And deregulation is going to allow big companies to crush small companies. It's going to be a tricky space. So, not a place I would really be in right now. Real estate, well, there'll be more large companies buying up real estate. So that could be good for selling real estate and so on and so forth, but not necessarily going to be good for home buyers and things. Rising rates are almost a given. I mean, you can't run up the deficit from 36 trillion to 40 trillion to 45 trillion to 50 trillion dollars without draining the available supply of money. And if you're draining the available supply of money, then money becomes more expensive, and then rates go up. No matter what the Fed says, rates will go up, and that will hurt the people borrowing homes. And it will not lead to more construction, and then the tariffs are going to cause construction materials to increase. Homes get more expensive in general. Utilities. This will be interesting because right now we are already turning down these alliances between the AI companies and the utility companies to jump in and do it. And the reason is, by the way, because the AI companies are making deals with the utility companies that says, okay, we're going to buy 25% of your nuclear capacity, and you're going to tell the government you need to increase your nuclear capacity. So it's not like, Microsoft is buying a tower of 3 Mile Island and gets it to themselves. It's that Microsoft makes a deal that they will buy X amount of power capacity, and the 3 Mile Island power company says, okay, we will open up this tower and get the government to do it because we have this much more demand. But the thing is, what Microsoft is doing is saying, we're going to buy this bulk amount of electricity from you at a very special price that specifically goes to us. And what they're really doing then is getting preferential treatment different from all the other consumers and taking a big chunk of the power cheaply. And then the company, due to the way regulations works, gets to look at their entire picture and ask for a rate increase. So everybody else will subsidize Microsoft's electricity. And this is why you need regulators to stop shit like this from happening. So Harris and Biden already told them no. They're going to go right back at it as soon as Trump's in, and they'll be told yes, because the regulator will be some completely unqualified guy who you know is very happy to take $100,000 and allow any crap you want. Crazy. Okay, so that renewable energy initiatives may be sidelined, and that means the whole green industry can start falling apart from lack of care. So no, while it's just when it's getting started, just when it's growing, just when it's becoming a major employer in the United States, the whole thing can be killed with a stroke of a pen. And who would imagine doing something like that? Well, could happen. You never know. Increased borrowing costs, and again, that's also difficult for the utility companies. All right. So again, the SPY. The S&P basically is just up and up and up. Everything's fantastic, but nobody's looking at the downside. Everybody thinks this is all going to be great. So it's the same crap we always talk about diversification. You want more domestic exposure. It's probably going to be better. And we got to be really careful about how policies actually play out and how they get implemented. All right, so that's where we are post-election and pre-Fed. Silly me, I thought we were... I thought the Fed was today. I don't know why I had that in my head. Because it's always Wednesday. That's why. It's not my fault. So tomorrow I will rant and rave in the chat room about what the Fed actually does. So tune in for that. And let's see if anybody has a last minute question. No questions. All right. Hopefully you can actually hear me. All right. Well, thank you for coming, everybody. I appreciate it. And we'll do this again next week. All right. Take care.